Good morning. I'm Richard Calhoun, Creekside Realty, real estate broker here in Silicon Valley for 40 plus years. We're here to discuss week number 43. We'll get back to this slide in a minute. We're talking about Bay Area data initially. We're talking about single family homes, 4 counties being Santa Clara County, Alameda, Contra Costa, San Mateo County. I typically look at data for 5 weeks to stabilize it, to get rid of the statistical fluctuations. And my current reference years are 2014 through 2021. This is looking at the DUI of the 4 different counties. You can see the key up at the top here. Blue is Santa Clara County. Deep orange is Alameda County. Contra Costa County is gray. And San Mateo County is the light orange or yellow. You can see they're all doing fairly well. We're in what's considered a balanced marketplace. Typically, Silicon Valley spends very little time in a balanced marketplace. It's either in a red hot seller's marketplace, which is defined as by myself as 40 days of unsold inventory or less, or in a nice cold buyer's marketplace, which is defined as 80 days or more. Here we're in a balanced marketplace, which is pretty unusual. Typically, we are transitioning between a good or bad marketplace. We don't spend much time in here. You can see all 4 counties are increasing, which is a slowing down of the marketplace. This is looking at the magnitude of overbidding. This is how much buyers bid up the sale price over the seller's list price. You can see the peak was basically at the beginning of April of this year. Depending on which county, it varies a little bit. Contra Costa County was the latest, about middle of April. The earliest one appears to be Santa Clara County, and that was basically about the 3rd week in March. You can see how rapidly all 4 counties came down, and now notice how they're pretty plateaued at 100%. Santa Clara County is currently doing the worst, but it's still fairly decently at about 99.5% of the sellers' asking prices, what they're getting on average. This tends to be right around 100% because typically buyers offer the seller some number close to what the seller is asking for. But you can see that it did get up. It got up to about 119%, but that was pretty unusual. Most of the time, you're much closer to the 100%, as I said. I define anything above 101.5%, so only 1.5% above the asking price, to be a red hot seller's marketplace. And on the downside, anything below 99% is an ice cold marketplace. And the reason for the unequal split, buyers tend to wait for a seller to reduce their asking price versus going in and offering low numbers. So it's harder to get that overbid number to go below 100% than it is to get it to go above 100%. This is looking at the weekly distribution. We'll come back to this more in detail, but each line on here is a different week, with the dotted lines being the oldest, then the dashed lines and the solid lines. And you might be asking yourself, where are all the solid lines? There are the same number, 8 solid lines right here together, but they're on top of one another, which is indicating that the market's at a plateau, which is why I have the red improving marketplace and the blue decreasing marketplace both shown, because we haven't moved at all essentially on this for the last 9 weeks. And the reason I'm saying 9 weeks instead of 8 is one of the dashed lines is here too, because if you count up the dashed lines, I think you're going to get 1, 2, 3, 4, 5, 6, and there's a 7th orange one up here. The 8th one is down here with all the solid lines, and you can't see it. So basically, for the last 9 weeks, we haven't moved. So here is your sold price that a lot of people are interested in. And this, to me, is not an indicator of where the market's going. It's an indication of where the market's in. So you can see the prices all went up and they've all come down. And then I've put in the horizontal line so you can come back and find out where you're equal to. And most of the counties are basically equal to where the median price was around April 1st of 2021, which is a difficult time to determine property values because that's a time when the prices are increasing very rapidly. It'd be a lot easier if it went back to January 1st, because then you have these long, relatively level periods of equal sale price. But you're on the peak. You could also come back and sort of say, if you get rid of the peak from basically April 1st through about May 31st, June 1st, and use the summer months, that's also a pretty good way to determine values. And you can sort of see that here's about August 1st, maybe July 15th through the end of the year and even into 2022. And you can see the prices are pretty flat, and that's exactly the same level that we're back to now. This is a table of key indicators. I like DUI. DUI is days of unsold inventory. It's a supply-demand ratio. You can see we're at basically 56 days for all the 4 counties combined, but it varies quite a bit. You got as many as 70 days in San Mateo County and as few as 45 days in Santa Clara County. So that's a huge difference between 2 neighboring counties. But this allows people to see the raw numbers for their specific thing. It's also interesting to see this huge drop in the number of new listings in Santa Clara County. It's 22% fewer listings and that's new listings only coming on the market this week than last week, where all the other counties are down around 5 or 7%. So that's a pretty noteworthy. Number of offers is pretty much, sort of plateaued. Normally it's going down a little bit at this time of the year. You can see you're down 1.5% overall, but again, there's a huge variation with Santa Clara County being down 7.5% and Contra Costa County being up 4%. But when you're looking at 1 week data, it fluctuates a lot, which is why I prefer the 5 week data, which is down here. And you can see there's still a fair amount of fluctuation, but they're all in the negative direction, which you expect at this time of the year. We have fewer and fewer sales happening between now and about the first week in January. But here you can see again, Contra Costa County is doing the best with only down 1%. Santa Clara County is not bad at 4.2%. Alameda County 6.5% down, and San Mateo County down 8%. Then you get them down to closings, and you can, again, when you get to closings, it's old data, but there you get sale price. So you can see the overbidding is around 35 to 50% in that range, which is a pretty wide range, but happens to be the range that I consider to be a balanced marketplace. Anything between 33% and 50% I consider to be a balanced marketplace. I add in the percent appreciation, and that's over the entire calendar year of 2020. So I'm not comparing year over year like a lot of media does, and even the industry. I'm not comparing month over month. I'm not comparing quarter over quarter. I'm taking every transaction in 2020, establishing that as my rock solid median, and we're up 20%. And you might say, wow, that's pretty good. You're up 10% a year. And that would be if we weren't up at 50% earlier. If you come over to condos, you can see the numbers are quite a bit lower, only 6% appreciation overall. And I should also point out, notice overall you're at 6% appreciation, but the lowest number up here is 8.8%. So each county has had essentially 9% appreciation, but when you loop the 4 counties together, you've only had 6% appreciation. And you might be wondering, how is that possible? If all of a sudden the less expensive county becomes a greater share of the marketplace, then your median price stays lower, even though property values go up. That's the whole concept between micro markets. And the whole reason that this Bay Area data that most of the media refers to is pretty much garbage as far as a lot of the indicators. You really can't tell what's happening with property values. You might be able to talk about what's happening with the speed of the marketplace, because that does tend to go up, although some areas are increasing while other areas are decreasing. But there is a difference between 60 days of unsold inventory and 80 days of unsold inventory if that's what's happening with the 4 counties. But you got to be careful on what you do with the data. We're back to the summary here. So the green is what I call my root URL. That takes you to the archives on YouTube. If you add in the year 2022, you get to the live presentation Saturday morning at 9. If you add in the letter H for handout, 2022, 10 for October, and then 29, you get the handout. And I actually got that up 5 minutes early today, about 20 minutes before the hour. My goal is 1:45. And if you want a specific episode, you get there. Anyway, with that, I'll pause and see if anyone's got questions. And if nobody has questions, I will continue and go into more detail. Not seeing anyone unmute themselves. Now what we're looking at is DUI in the big, broad blue line. This is the most important indicator, in my opinion, and it's simply the ratio between the active listings in the gray line and the offers being accepted. The DUI is the most important because it's a ratio between the supply and demand. If your inventory doubles and your offers double, that really doesn't impact the speed that the buyers feel, and it really doesn't impact the market at all. But if all of a sudden your inventory doubles and your number of offers doesn't change, change, all of a sudden there's going to be a whole lot more inventory and a lot less pressure. So again, you can see the rapid increase starting basically April 1st, and this is for all 4 counties in a blender. You can see we slowed way down till July 4th, then we improved for the month of July, and then we've been decreasing or increasing, which is a decreasing marketplace, a slowing marketplace. Again, I consider anything between 40, which is down here, and 80 at the top of the graph to be a balanced marketplace. So we're in a balanced marketplace. The reason we're feeling such a slowdown is there's a huge difference between 55 days of unsold inventory and 15 days of unsold inventory, which is where we were just at the beginning part of this year and last year, or at the end of last year. Now we have the number of offers on the bold, in the brown, the orange, and you can see the number of offers comes down at the end of the year. You can see the pandemic slowdown in the number of offers accepted. You can see we were following the normal trend, but instead of that normal trend continuing until about the middle of June, all of a sudden it turned around and started coming down middle of April, and it came down. Then this was the improvement during the month of July, and then here's the current downturn. So the downturn normally starts right about where we are now, right around November 1st. So the downturn going forward now doesn't surprise me, but you can see we're dramatically lower than we were the last couple of years. The other thing that I want to point out is, see the verticalness here at the end? That's almost to the point where I may not report this last data point. This last data point is through midnight last night, and I report that to have it, but it's misleading in the fact that a fair number of agents report their listing sales late, and therefore, even though the sale occurred last night, it doesn't get reported until today or Monday, and therefore the number of offers being accepted is artificially low. And that's why this last data point drops so much. That's why the DUI up here in the blue goes up so much, and active inventory really is behaving normally. It's simply a late report. So I'm thinking that for the number of offers, I may have to delay that by 1 day, which I hate to do because I want to know what's going on through Friday. But you have to take the last data point with a grain of salt with the number of offers. Now we're looking at the gray line, which is bold, and that's the number of total inventory that's available on the market. And that you read off the right-hand axis. So we have about 4,000 listings in the 4-county area. And this is single-family homes again only. I'm not doing the blended data of adding in condos and townhouses. Now we're looking at DUI, the purple line, and we're comparing it to the norm. The norm is that 2014 through 2021 time period that I was talking about, where the red line down here is what the DUI is in the hottest 10 percentile, which is about the second best year. And the blue is the 90 percentile, or the slowest 10%, which works out to be about the second worst year. And the gray line in the middle is the median. And the reason I do that is you can see there's an annual cycle on here. So you want to compare DUI now compared to what DUI normally is. So DUI is normally down here somewhere around 38 days, which is a pretty aggressive marketplace. And yet in reality, you can see now we're up here around 58 days of unsold inventory. The downward turn that you saw in the last graph, this is just a fluke that's in the data because that's old data that is well stabilized, but the increase in the DUI is impacted by the late reports of offers. So now what you're doing is you're taking DUI for the 4 counties for single family homes, and you're subtracting off the median for the same week for the 2014 through 2021 time period. So if you're having a completely normal year, you'd be right on this black horizontal line. So you can see earlier, late last year and earlier this year, your DUI was below where you'd expect it to be. DUI, the lower the DUI is, the quicker the marketplace is. So you had a very quick marketplace earlier this year. Then the market slowed down and you had a slower marketplace than you normally do. Then the market improved and you were basically back, almost hit an absolutely normal year again right here at the end of September. And now you're turning around and you're rapidly slowing down. So the slowdown that we're experiencing right now is more significant than the slowdown we normally experience at this time of the year. And this is the DUI for each of the 4 counties that we've actually saw before in the summary. Here's the number of offers accepted. This is the same concept as the last slide, where the blue line is the 10 percentile. So it's the second worst year of what you'd expect it to be. The median is where you'd expect the number of offers to be. And the red line is the second best year we really had. So now you're down here and you're having a very low number of offers accepted. So the volume of transactions is really low. So that impacts our lenders, that impacts our termite companies, that impacts real estate agents. We may be getting a little bit less on each commission, but we're having a whole lot fewer commissions. And we'll get into the number of offers accepted now in a little bit, but we're basically the 24th slowest number of offers accepted out of the last 25 years. And it'll be a while before we get there, but that's a spoiler alert. Now you're looking at the percentage of offers of the total marketplace. So San Mateo County is down here because it's the smallest county. It has the fewest transactions. It's typically right around 12%. Your other 3 counties are actually surprisingly close together. They're all right around 28, 30%, and together they add up to 100% of the marketplace. But you can see that there's some fluctuation. The blue line here, Santa Clara County, came down, so it was becoming a less relative. It was selling fewer homes than its normal percentage. Right now, the dark orange, Alameda County, is sort of selling more than it typically does. And you can see there's been a few spikes right here, and then way back here in 2020 when Contra Costa was a huge increase. And since both of those are at the end of the year holidays, it almost suggests to me that people that are buying in Contra Costa County are less families, because families tend to, and more established families tend to take holidays. If they take holidays, they're off and they're not buying real estate. So to see this spike up for 2 years is sort of interesting, and I should look at the trend to see if that continues for the most, but I would not normally have thought that on a county basis. This is the delta offers. So now the black horizontal line is the median number. This is the number of offers you'd expect. And again, that's based on the median of that 2014 through 2021 time frame for the same week. And you can see we're selling about 400 fewer listings than you'd expect. When I say a week, it's a week, but it's for a 5-week period of time. So this week's data goes back for 5 weeks, because we're not selling 400 homes a week, let alone having 400 fewer homes sell each week. So that's basically 75, 80 homes fewer being sold each week. Since it's 5 weeks, I guess it's 80 days, 80 homes fewer being sold. That's single family homes. That's all 4 counties. This is the actual number. So you can see San Mateo County has the fewest number, and you can see the other 3 counties are fairly similarly shaped and also similar volume. And again, you can see Contra Costa coming up a little bit here at the end of the year of 2020. And they're also on the top here. On some of the vertical rises, it's hard to tell, but overall, I would say they're very similar magnitude. They don't exactly agree, but they're similar magnitude. Here's your active inventory, then the purple line compared to where you'd expect. Again, the black line is exactly the median you'd expect it to have. So our inventory is right where you'd expect it to be. So that means that the sellers are adjusting. The market has slowed down. The sellers aren't coming on the marketplace. They realize it's not a great marketplace like it had been, so they're delaying their plans. And we'll actually see there's a shortage compared to the median of single-family homes in Santa Clara County. Here's the number of active listings for each of the counties, and you can almost sort of see it, because if the counties are the same, you'd expect the inventory to be the same. And here's Santa Clara County is significantly below where you'd expect it to be. Here's the delta, the difference between where you'd expect. So again, you can see it's very small. You can see there was actually a shortage only a few weeks ago of inventory, which I think would surprise people. Right around July 1st, we had the surplus. And then we had a shortage going back in 2022 and 2021. Again, what I'm doing is normalizing it to the 2014 through 2021 time period. Here's looking at the magnitude of overbidding. This one is a little different. You go to the outside blue lines, and this is my 2.5 percentile. This is my 97.5 percentile. And the reason I do that is to get rid of the outliers. The outliers can be bad data points where someone reported a property selling for 510 million instead of 510,000. That would have a sale price to list price ratio of 1,000. And if I was looking at min and max, they'd be way up. So by eliminating 2.5% of the data on each side, I sort of normalize it. So this is my normalized max. This is my normalized min. So basically you can say that 95% of the properties, and 95% is pretty close to all, but 95% of the properties sell between 88% and about 129% of the seller's asking price. Then the two paired gray lines are my 10 percentile and 90 percentile. So 80% of the lines are between these two lines. So you can see that even 15%, 7.5% here and 7.5% here is not a lot of volume, and it really makes a huge difference and brings in the sale price to list price ratio, the overbid. And then the paired green lines are my quartiles. That's 25 percentile here and 75 percentile here. So 50% of the market sells between this. So that's basically somewhere around 96% to somewhere around 104%. So in a 8% swing within 8% of the seller's asking price, you're selling half your homes. And then the dark green lines, the solid dark green line is your median, which I normally am a big fan of, but on overbidding, that really doesn't work because a lot of times you're going to be exactly at 100% with zero fluctuation. The dotted green, dark green line is your average. And even though it's getting fairly level, you can see there's little fluctuations, so you can see the market changing a little bit. Normally, average is not a very good indicator, but I believe for magnitude of overbidding, since you're always going to be centered around 100%, you almost have to watch the average instead of the median. Here's the delta overbidding. This is the expected level of overbidding, the black horizontal line. That's simply, again, defined by the median overbidding for the 5-week period of time ending each midnight, Friday midnight, going back for 5 weeks. You can see we were way up. We were almost 6% above the overbidding you'd expect, and we got all the way down to minus 2.5%, and right now we're only 1% lower than you typically are. This tends to be pretty close to 100%, but you can see the huge perturbation that we went through. And I have, if you haven't already noticed, deleted the data going back to 2014. I thought it was just too much data to try to cram in, and I'm not sure it added any value to the presentation. If anyone would like it added back in, reach out to me and let me know. Here is the magnitude overbidding, so you can see how rapidly we decreased, and now you can see the plateaus for all 4 counties. You know, there really hasn't been much change, and that's why the magnitude overbidding really has not changed, and why on that previous graph with all the lines, it's sort of been flat, is you're reflecting the fact that the overbidding is pretty constant. Here's overbidding for each of the counties. So now I subtract the county compared to the 4 county median. So you take the overbid for the individual county and subtract the median, and you can see they're all pretty close together. Santa Clara County is actually doing the worst, and you saw that in the previous slide. Santa Clara County was the only one below really 100%. So whatever the median is for the 4 counties, you'd expect Santa Clara County to be below that. And because the other 3 counties were all real close together, you'd expect them to be real close together. And they were on the 100% line, so you'd expect them to be on the median line here. But you can see when you go back in time, there's a differential. Like here, Contra Costa County was doing significantly worse than the other 3 counties. Here, Alameda County was doing significantly better. This one I can actually explain. To me, it's related to the pandemic. The pandemic was basically right here. Coming out of the pandemic, Alameda County started doing better. Why? People were willing to commute a little bit further to get a little bit more house for their money. So Alameda County saw more price appreciation. Here's the magnitude overbidding, which we've seen before. You can see the rapid decrease, and you can see the horizontalness in the recent time right around October the 1st. Now we're going to get into overbidding in a weekly basis. So the dotted line up here, the dashed line, the red dashed line, is the best week we ever had. And you can come up here and see that was April 12th of 2022. Some of you may remember that I used to say the best week we had was March 26th. That was Santa Clara County, San Mateo County condos and townhouses. This now is single family only, and I've added in Alameda County and Contra Costa County. That's why the little bit of difference, but this is the best week we ever had. This is the worst week we ever had, which was November 30th, 2001. The purple line is the current week. The reason I have the up arrow is because the next slide coming up is going to be a year ago, and a year ago the market was improving. So now what I'm going to do is add in one line at a time. We're going to start off a year ago, 11 months ago, 10 months ago, and then when we get down to 3 months, it's going to be 3 months, 12 weeks, 11 weeks, and I'll set it off so you can see it. So here you are here. Now you've gone up a little bit, so that's the improving. That explains the up arrow, and improved again a little bit. You're right here, just a little bit above, and again a little step above. Now a huge step up, this blue line. Now you're way up here. You can see it down over here. Now you're basically in the same spot because you can see it up through here. Now you're stepping down, which is why the blue arrow. Now you're down here with the dashed line. Big jump down here. Again, another dashed line, so you can see you're stepping down, which explains the blue arrow. And in a minute or two, when we get, well, 30 seconds, when we get to the solid lines, you'll notice that you can't really tell where they are anymore, and that's because they're on top of one another. I think you're going to be able to see one more slide come in right up through right there. See that? And now it's level because you can see, and one more line right here, and there's the first solid line, but those are right on top of one another that you can't really tell. That one came up a little bit low on this side. That's really just statistical fluctuation. Now we're going to go October 11th, the 18th, and now we're out to the 29th. So now we're all the way through midnight last night. The purple line, I only go through the 25th because it's a lot more stable. You don't have any corrections. You don't have any reports of late closings and those kinds of issues. Here's the magnitude overbidding. We have same concept as the price. Actually, I thought I already did this slide. I'm going to have to look through this. But same concept, your blue lines are in 2.5% each way. So 95% of the properties are between those two numbers. 80% of the properties are between the gray lines. 50% are between the green lines. The dark green solid lines are median, and the dashed line is your average. And I definitely did that earlier. Here's your overbidding frequency. I think some of these slides are repeat. Now what you're looking at is the frequency of overbidding. The solid line up here, the blue line, is the sellers that are getting more than their asking price. And you can see they're a little bit below the brown line. The brown line is the sellers that are getting less than their asking price. So they're both right around 45, 46%. And then finally, the gray line are the people that are getting exactly their asking price. Here's the magnitude of overbidding, and you can see the dramatic downcrease and up, and I'm going through this quickly because we've talked about it. Here's sale price. We hit this earlier, but you're going back to about April of 2021. Here is the slide where I put in. So you can see this column right here, 25 years. You're the 24th worst year out of the last 25, and the year that was worse was basically 2007. There are some weeks back in July where we're actually the 25th worst week out of the last 25th. So we set a record low number of offers accepted. And then just earlier this year, we were the 10th best. And the reason I was hesitant to do 25th 5 years is there's been a trend where we're selling fewer and fewer homes every year instead of more homes. Earlier this year, we were the second best, and now we're the worst year. But for really driving home, I wanted to bring up this lack of offers. We've got the 24th worst year out of 25 years. Now we're doing blended data, which is Santa Clara County, San Mateo County, and single-family homes and condos. Here's your DUI over time. You can see we are in May, even though we're past the peak of the marketplace, you are much redder than you are now. And you can see a few ebbs and flows where right here you were sort of the palest. And you are starting to get a little darker right now, at least in some micro market areas. Here's my heat map of the current days on unsold inventory. A lot of the heat center of Silicon Valley is in a hot marketplace as defined by less than 40 days. So we have that shortage of inventory, but we also have a shortage of offers. So you basically have almost something similar to stagflation where the market's moving rapidly, but there's very little volume to the marketplace. Here's the overbidding of the different micro market areas, and you can see Morgan Hill's pretty blue. You can see the expensive areas in San Mateo County are blue. This is the frequency of overbidding, which is how common overbidding is. And you can see in San Mateo County North up here, you got a fair amount of overbidding. The West Peninsula area has a fair amount of overbidding, and you can see the actual numbers. This has nothing to do with the speed of the marketplace. This has to do with the price. The median price is basically Redwood City, and if you're blue, you're below the median price. If you're red, you're above the median price. Over in the actual table, the middle number is the median. The number to the left is the cheapest 10 percentile in a given neighborhood or micro market, and the number to the right is the most expensive 90% in the given area. Here is the micro market conditions, DUI, magnitude, frequency of overbidding, and then the sale price. This is the current data. So you can see that the inventory is lacking in Santa Clara County. We only have 72% of the inventory you'd expect. Where you go over into San Mateo County, they have 135% of the inventory. They have 64 days of unsold inventory. We only have 45. We're doing roughly the same on magnitude of overbidding. San Mateo County is actually doing a little bit better than us, which is surprising given the slower marketplace and then the frequency of overbidding. So San Mateo County has more overbidding, even though it's a slower marketplace, which is not what you'd expect, but that's statistical fluctuation. Appreciation, they've only been 6% appreciation over the 2020 calendar year, where Santa Clara County has been 17%. And then condos are at the bottom. Here's the appreciation for the micro market areas, and you can see San Mateo County Coast is minus 0.4%. San Mateo County North condos is minus 8%. Most of the numbers are pretty respectable, being 10 to 20%, which would be fantastic normally, but those numbers were in the 35 to 50, 55 percentile range. Here is data that's comparing October data going back for 20 years. You got to be a little careful because you can't get October data until November the 5th because I need data through the 4th, but I'm doing this year through the 28th, getting it on the 29th, and it's the closest you have without looking backwards in time. So if you come down here, offers accepted 682, I believe that number is, and you can see that that's the lowest number in the last 20 years. If you come back to 2007, it was 714. Then you have the overbidding down here, and then finally the price. We're still at 1.6 million, which is where we were a year ago. And here is for people that want to be purist and compare apples to apples. This is September data. The reason I put in the October data is September data is in the rearview mirror. And with that, I'm open for anyone that has any questions, and I still would appreciate more feedback on the slides, whether I'm doing them right, wrong, or indifferent, which ones you'd like to have on there. Well, I guess I should go over the URLs one more time. I think I can go over the URLs one more time. And this is a slide you get if you beat me to the meetings on Saturday morning. Ignore the date, but I'll be on at 9 o'clock or within a minute or two. The green URL is the root URL. Yeah, 2022 to join live Saturday morning. H for handout 2022, 10 for October, 29 for today's date to get the handout, and it's posted. And I'm done yakking, so if anyone's got a question, otherwise I'll end the meeting. Not seeing anyone unmute themselves. Have a great week, everybody. Take care.